If you invest in real estate and you've spent any time on YouTube, TikTok, or real estate forums, you've probably heard this phrase before: real estate professional status. And usually, it's presented like some kind of secret tax hack. People online make it sound simple. Just qualify as a real estate professional and pay less tax. But here's the reality. Most investors either misunderstand it completely or assume they qualify when they actually don't. And that can become a serious problem if the IRS ever looks closely at your return. So in this video, I want to break down what real estate professional status actually is, who may qualify, how eligibility works, and why this strategy is much more technical than social media makes it sound. Let's start with the biggest misunderstanding immediately. Real estate professional status does not mean you work in real estate. That surprises a lot of people. You can be a real estate agent and still not qualify. And you can qualify even if you are not a traditional real estate agent. Because this is not about your job title. It is about your activity and participation. Now let's step back for a second and talk about why people care about this status so much. Normally, rental real estate losses are considered passive losses, and passive losses are limited. That means many investors cannot fully use their rental losses to offset active income like W-2 wages or business income. Instead, those losses may carry forward into future years. But if you qualify for real estate professional status, the rules may change. Under the right circumstances, rental losses may no longer be treated as passive, and that can create significant tax planning opportunities. Now here's where social media oversimplifies everything. People hear this and think, so I just buy a rental property and write everything off. No, that is not how it works. There are eligibility requirements, and the IRS pays close attention to them. Now let's talk about the first major requirement: time. To qualify, you generally need to spend more than 750 hours during the year in real property trades or businesses in which you materially participate. That sounds straightforward until you realize how much time 750 hours actually is. That is a serious commitment. Now let's move into the second major requirement. More than half of your total working time during the year must be spent in real property trades or businesses. And this is where many high-income W-2 earners run into problems. Imagine someone works a full-time corporate job requiring 2,000 hours a year. They also own rental properties on the side. Even if they spend several hundred hours on those rentals, they may still fail the more than half test because their primary working time is elsewhere. This is why qualifying can be harder than people expect. Now let's talk about what counts as qualifying real estate activities. Activities may include property management, leasing, acquisition activities, repairs and maintenance coordination, development, construction, brokerage activities. But here's the important part. The hours must generally involve material participation. Passive ownership alone is not enough. And no, simply checking your rental income app from your phone does not suddenly count as active participation. Now let's discuss something that becomes extremely important if you ever need to defend your status: documentation. This is where many investors fail. They claim real estate professional status, but they cannot prove their hours. And if the IRS questions the return, vague estimates are usually not enough. Strong documentation matters. Calendars, logs, emails, appointment records, property management activities. The goal is to create a clear timeline of participation. Now moving forward, let's talk about married couples because this creates confusion too. For tax purposes, one spouse may qualify individually and allow the couple to benefit jointly on a married filing joint return. But here's the key. The qualification tests are generally applied at the individual level. So one spouse must independently satisfy the requirements. This is why many real estate investors strategically structure responsibilities between spouses. Now let's shift into another important concept: material participation. Qualifying for real estate professional status alone is not enough. You must also materially participate in the rental activity itself. That means being actively involved in operations and management decisions. The IRS has multiple tests for material participation, and this is where details matter. Because investors often assume ownership automatically equals participation. It does not. Now let's address a major mistake we see online. Some influencers make it sound like this strategy eliminates taxes completely. That is misleading. Real estate professional status is not magic. It is simply a classification that changes how certain rental losses are treated under tax rules. The actual tax impact depends on your income, losses, depreciation, and overall financial structure. Now let's talk about why this strategy gets so much attention. Real estate already offers powerful tax advantages. depreciation, expense deductions, cost segregation opportunities. When these benefits combine with real estate professional status, the tax impact can become significant, and that is why people are interested in it. But again, qualification matters. Now let's move into something practical. How do investors usually get into trouble with this? Typically, one of three things happens. First, they assume they qualify without tracking hours. Second, they misunderstand what activities count. Third, they rely on aggressive advice from social media without understanding the actual IRS rules. That combination creates risk. Now let's talk about strategy. Smart investors do not treat this casually. They evaluate how much time they actually spend in real estate, whether the hours are properly documented, whether material participation tests are met, and whether claiming the status makes sense for their situation. Because not every investor needs this strategy, and not every investor qualifies. Now let's discuss something that many people overlook. This strategy works best when integrated into a broader tax plan. Your business structure matters. Your income sources matter. Your depreciation strategy matters. Everything connects. That is why experienced real estate tax advisors look at the entire financial picture instead of focusing on one isolated tactic. Now let's bring this all together. Real estate professional status is one of the most talked about tax strategies in real estate investing, but it is also one of the most misunderstood. It is not based on your title. It is based on your activity, participation, and documented time. The potential benefits can be significant, especially for investors with substantial rental losses. But qualification requires careful attention to IRS rules and strong documentation. This is not a strategy to guess your way through. It is a strategy that should be approached carefully and intentionally. If you are investing in real estate and wondering whether real estate professional status could apply to you, start by reviewing your actual time, responsibilities, and participation honestly. Because the difference between "I think I qualify" and "I can prove I qualify" matters a lot. If this video helped clarify how real estate professional status actually works, subscribe to our channel. We create weekly content designed to simplify complex tax strategies for real estate investors and business owners who want more clarity and fewer costly mistakes. And if you want deeper insights into real estate tax planning strategies, visit GavTax.com for more resources. Thanks for watching, and I'll see you in the next video.